Thanks very much for that, Shay. Appreciate it. Francis Tan is Chief Strategist Asia at Indo-Suez Wealth Management. He is also our guest host this hour to talk about all things that are important for the markets this week, starting off with Trump. Lovely to see you on the show, Francis, and thank you very much for spending the time to be with us this hour. What's your own sense of what sets the tone, given that it's inauguration day in the U.S.?
Well, today is a very, I would say, historically important day that we are going to see. More importantly, is that the world is now looking at Trump, whether he will continue what he talked about during his on his road to the elections back last year. Well, some of the key things that, especially if I go around the region talking to business people, investors, they're always only looking at a couple of things. And the key line of thought right now is that Trump promised more tariffs against, let's say, China in this case. Tariffs will bring about inflation, great inflation into the US. Because of that, the Fed may not be able to cut rates much, and the Fed may have to defend itself. There are even some voices out there saying that the Fed could even hike rates. And that will cause a lot of implication thereon for equities, for bonds, fixed income, and things like that. So this is currently, I would say, that the key or the majority thinking out there right now. But over at Indo-Suez, we will be looking more at the economic conditions in the US right now. First of all, the US continues to be in the disinflation. We note that housing is 40% weightage of the entire consumer basket. And that has nothing to do with the tariff, or rather I would say minimally. Of course, you may import some construction materials that impact housing prices, but at the end of the day, it's not. The key thing is, right, we are still seeing disinflation in the US housing market, and that should act as a big resistance against inflation from running away. Second thing, we will be also seeing that, recall back when Trump was the president last time, back in 2017 to 2021, we do see that the US average inflation, headline CPI, didn't move anything significantly above 2%. In fact, on average, during that 4 years, it was only 1.9%. So it didn't really move a lot of inflation or imported a lot of inflation into the US. There are a couple of reasons behind that. Number one, the Chinese factories were cutting prices as well, as a buffer against the higher tariff. Number two, the renminbi depreciated. At one time, it depreciated around 12.4% against the US dollar. So that was another buffer. So there are a couple of reasons why I don't think this time around you'll be as high as an inflation that the whole market is worried about.
Right. So a lot of what President Trump might do, you know, the playbook and the comparison is being made to his first term, right? And my question really is, would he be more hawkish than he was in his first term, or would he be more dovish once he gets into the office than he was in his first term?
Okay, it seems like a 0 or 1 binary question, but from some of the recent news about Trump, especially with him talking about TikTok as well, I guess Trump may not be as hawkish as what the whole world was expecting when he was upcoming as during the election rally. So right now, with a more benign, probably, I think condition, I think that Trump may not be as hawkish as we think at the end of the day.
Yeah, because I always look at it from, you know, from a psychological perspective. You know, he doesn't have to prove anything to anybody now. He's in the White House for the second time around. And he has, of course, all his policies laid out before him. This is his second term. There's not going to be a third term ever. So if he wants, he can play it cool. That is only if he wants, and that's where the unpredictability angle comes in. I just want to understand what that means for China. What are you telling clients about what that means for China, Francis?
So the key thing right now is that everyone will be afraid about the externally oriented portion of the economy for China, because at the end of the day, the playbook is the same. If you're going to see a lot more tariffs coming in, you're going to see a sharp slowdown in your external sectors, which means trade, the logistics sectors, which means the manufacturing sector. For now, I'm telling my investors mainly that the China today is very different from the China 8 years ago when Trump was president during that time. In fact, China shifted so much in a way that the world didn't realize during the pandemic. And when the world woke up 2 to 3 years later, China has gone up the technological scale quickly, very, very much quickly. We have seen back in 2012 when President Xi Jinping talked about the Made in China 2025, guess what? This year we are in 2025, it's 10 years. And I would say that the report card is really, really good. China today has got a big technological advantage over many other countries in the world. The products that they produce, you can't really find anywhere anywhere else in the world as well.
Yeah.
So for one, I think China today is very different, and they have something to bring up to the negotiation table if the two leaders were to meet today versus 8 years ago. So I would say China today a lot more powerful than what we have heard. Yeah.
Well, just a phone call between them has assuaged concerns among investors and, you know, is kind of calming the markets and sentiment overall. So we'll have to see how things play out on that front. But you're my co-anchor for the 1 hour, right?
Yes.
And so you're our guest host for the 1 hour, the first hour of the show. So we will come back and chat more about the markets in 2 short minutes. Stay right there. And we're back with Francis Tan, Chief Strategist Asia at Indo-Suez Wealth Management. And let's talk a little bit about China, Francis, as you know, in about 15 minutes, actually 10 minutes, the markets open for the week and for the session. What's your own take on what we are seeing with the economy and what we are seeing in terms of investor sentiment purely related to the equity markets?
That's true. Well, in terms of economy, we have, of course, received the latest GDP numbers from China over the course of the entire 2024, 5% at the target, very nicely. But the economy is growing on 2 separate speeds right now. Number one, we are seeing that services is indeed quite a good buffer. So domestic consumption, domestic services will be a good buffer for China against all sorts of geopolitical risks for 2025. So if you think about it, the castle is more strong right now, the Chinese castle, because domestic demand is really, really strong from a 1.4 billion population that you have over there. Second thing, we do see some sharp uptick in factory activities towards the end of 2024, and that came up in the nicer industrial production numbers that we saw in the recent numbers. And we do see that Chinese PMI over the last 3 months in 2024 were higher than your usual mean or even median. This shows quite a bit of a front loading of factory activities to export to the US before Trump is inaugurated as president. So that helped a little bit for China to move towards the 5% overall full year mark in 2024. However, this year we may not see a 5% because one of the engines, which is the manufacturing engine, may slow quite substantially in response to the potential upcoming tariff, right? But however, the thing right now is that we are concentrating a lot more on the domestic services, and that should be much in a better shape this year compared to any time over the last 2 to 3 years because of the physical and the monetary stimulus that China is coming in now to make sure that the Chinese castle is even more buffed up against any external negative forces right now. Now, next, you are talking about the Chinese equities and fixed income. Right now, a lot of investors are scratching their heads thinking, why is the fixed income market painting a bearish scenario in the whole of Chinese economy? Yields are all-time low. Just putting money there, you get some nice capital returns over the last 1 year in the Chinese government bonds. But overall, in the equity markets, especially after September, October, we do see some green shoots in the Chinese equity market. So on one hand, Tanvir, equities market is pointing to a better future in 2025. Bond markets, however, is on the other end. They're painting a much more negative picture because the bond holders are thinking there's nothing much I can do. It's going to be deflation. Let's put more money into it.
China's not going to default, so buy safety.
Exactly. So I would say that over the last 2 to 3 years, because of the situation we have in a massive storage of wealth, which is property sector, the real estate sector, and also that the equity sector has been facing quite a bit of a clampdown from the Chinese policymakers. If you are a Chinese investor, where else will you put money? You put it in bonds, because there simply isn't many other places for you to put your money. Of course, you put some in gold, and that could potentially explain some of the increase in the gold prices over the last 2 to 3 years. But right now, I'm seeing 2025, which is at the end of the in 2025 China right now. I'm seeing quite a big reversal this year. I will have to say that the equities market will have its final laugh. And the bond holders this year may finally realize that things are actually improving after so many years.
Okay, great. And we'll carry on the China conversation because in the next segment, we are joined by a special guest, a China expert on the same issue. We'll take a short break right now, but greater China markets, Hong Kong and mainland China markets will be coming online soon. In 4 minutes, 47 seconds, we'll get you the opening trades as always this Monday morning right here on Street Times. Don't go anywhere. Thanks very much for that, Em. Let's touch base with our next guest. Tao Xu is Chief Economist at Deloitte China. Our guest host, Francis Tan of Indo-Suez Wealth Management, is right here with me, next to me. Tao, lovely to have you on the show. Thank you very much for your time, sir. What is your own sense on how this week would pan out? Because right from the get-go, there is expected to be some sort of tariff announcement. Now, to what magnitude, how much, and how is China preparing for that? Because there is expectation that there could be retaliatory measures. What's your sense?
Yeah. Well, first of all, we need to separate, campaign grandstanding and real policy intention. I do believe President Trump has very strong conviction in tariffs, and I also believe a lot of cabinet members share the same views. But at the same time, we all know the borrowing costs have been pushed much higher. Long-term interest rate has been flirting with the 5%. So I think that's going to be a constraint. I do believe President Trump is watching financial market extremely closely. And of course, the difference between Trump 2.0 versus Trump 1.0 on tariff is not just China. All surplus countries, essentially most economies in our part of the world, with the exception of India, Australia, New Zealand. So I think in the end, tariffs would go higher, but not nearly as high as what he said during the campaign. So probably 10 to 15% with different phases. What China is going to do is to make pro-consumption policy more potent, and of course also a bit adjustment on the exchange rate as a hedge for such an external shock.
Francis?
Yep. Hi, Sutao. Good morning. This is Francis over here.
Good morning.
Good morning. Yeah, I was looking at the 10-year yield differential between the US and also of the Chinese government bonds. Now the spread is about 3%. Well, do you think it's going to have more depreciating effect on the renminbi going forward into 2025?
Yeah. Well, I don't think Chinese currency RMB is making Chinese exporters less competitive. What we've been seeing in past 2 years, really just a strong performance of China's external sector. But as economy is showing sign of deflation, long-term interest rate, approaching 1%, there is a strong argument of making the exchange rate more flexible so that you can bring down a real interest rate. But of course, that's also going to result in backlash from China's trading partners. So my policy recommendation is adjusting the exchange rate at the same time to open up service sectors more so that China could mitigate some of this backlash.
That's right. So earlier in the previous segment, I was talking to Tanvir, and we were talking about how China is going to buff itself even further this year against all sorts of potential geopolitical tensions in the form of tariff. The external sector of China could be indeed affected. So domestically, China has got to buff up even more to tap on the 1.4 billion population demand. However, in the most recent release of data from China, I do see quite a big divide between the supply side numbers, which is industrial production, which is the services activity that is doing quite well, versus the demand side of things, which is your retail sales, which is your fixed asset investment, that's not doing that well. So how do you reconcile this, and will you think by the end of 2025, the demand side of things in China can finally catch up with the supply side?
Demand side, I think, will improve. But whether that's going to catch supply side, I think that's a long-term issue. What China is likely to do is to broaden the so-called cash for clunker program. Of course, someone like you may say this is still targeting producers rather than consumers. But if you look at how Chinese consumers behave, housing still the most important source of assets, accounting for 70% of balance sheet. So cash for clunker program should go far beyond appliances, mobile phones. So if this program can be targeted to make renovation and home improvement much more affordable, I do think consumers will react.
Right. So now I want to understand the weakness in the currency and how China might leverage that to offset the tariff increases or the new tariffs that might get imposed. Now, Francis and I were discussing that the last time the tariffs came through, the currency weakened 12%, and people are extrapolating that for projecting that there could be weakness of anywhere between 10 to 12%, even if the tariffs were to match the tariffs of 2019, which is about anywhere between 20, 25%. That would take the renminbi to roughly 8.3, right?
Okay.
Let's assume roughly it takes a renminbi beyond 8. Can China afford such a weak currency? And would that be good for the rest of Asia that does trade with China?
That wouldn't be good for rest of Asia because many of the regional economies, their industrialization process, you may say, has been, delayed by China's emergence. So for a country like Indonesia, Thailand, they are watching this with a lot of anxiety. And China is going to be sensitive. If you recall what China did during the Asian financial crisis, China held the currency stable. But will China do the same, just being altruistic? Probably not. But will China have a very significant adjustment? And probably not, unlikely. I mean, in the end, China is not Japan. I mean, Japan can do this quite freely, but China has to be more sensitive. So in the end, I think there will be adjustment, maybe 5%, 6%, but I seriously doubt would go to 8 to 8.3, as you suggested.
Right, so I was also again talking to Tanvir that Trump's presidency 2.0, he's going to leave a legacy, and I think right now it seems like he's softening up a little bit more, less hawkish, wanting to make more friends around the world rather than enemies. However, if he's coming in really, really tough and onto the negotiation with China, 8 years later, right now, China, what tools for negotiation do you think China has today when meeting with President Trump?
I think both sides have to learn lessons from 2018 trade war. I think the first lesson is if we just set a target as phase one trade deal with the quantity, I don't think that approach is going to be sustainable for both countries. Secondly, China has, to a large extent, diversified from the U.S. market. You can see that from the data, and China's exporters just remain extremely competitive. So China does have some leverage, but I think China is unlikely to do what China did in 2018, 2019, this tit for tat. And so far, as you see, China has been trying very hard to lower the temperature. I also believe Trump, who has been emphasizing this reciprocity, which really means China needs to open up domestic market, service sector particularly.
Sital, thank you very much for joining us and giving us your perspective on how the new presidency in the U.S. could impact China's economic future. Thank you very much for joining us. And also, thank you to our guest host, Francis Tan of Indo-Suez Wealth Management. Thank you, Francis, for coming by and speaking with us this morning. Setting the scene, really, for the week. Yeah. We are back in 2 minutes with more from our exclusive conversation with TSMC CFO Wendell Huang.